So I am at a duplex in Park Hill. We're at the back unit of a duplex here. Got back alley access, situated sideways with the front street out there. And this duplex, a landlord owned for many years, and he needed to get money out of the property, but had depreciated it significantly. So a trick that you can do that we did on this one, and if you're a landlord and you have a property that you have a lot of equity tied up in, and you'd like to get some of that equity out, but you don't want to have the tax liability, right? Because if you fully depreciate a property that you own as a rental and you sell it, most of the time you end up giving all of your profits to the government in taxes, or most. So there's a way to get around that, and I'm going to teach you that in this video. But first I want to show you kind of quick how our finished product ended up. And we have all new flooring everywhere. If you go back and look at some of our old videos, you'll see what it looked like when we started. When we put new tile in here, new fixtures, a new vanity floor, and this tub we're gonna refinish. So it's the last thing we're kind of getting done with. Pictures are tomorrow. Today happens to be a Tuesday, then tomorrow's Wednesday. We'll have the images on Thursday. We can hit the market on Friday morning. But here, I just will walk over to the front unit, which is a little behind this one. We'll still finish everything today, and I'll kind of talk to you about how to avoid the taxes on a situation like this. So if you have a property that's a rental that you sell, the two ways to avoid losing all of your profits to taxes are a 1031 exchange, or to buy another property in the same calendar year and bonus depreciate the property off, which gives you a loss to offset the gain that you had from the property you sold. So for instance, easy numbers, say you sell this property and you make like $200,000, right? And you would owe almost the whole $200,000 in taxes because you've depreciated the property quite a bit. Let's say that's your case. 1031 exchange allows you to move that money into a new property, but that doesn't let you get the equity. And if you need the capital, right? Because you want to buy a new toy, or you're just kind of behind on your bills and you need some cash out of this thing, well, 1031 exchange isn't going to work anymore. Another way to do it is in the same calendar year that you sell the property, right? Say you make the $200,000 in that same calendar year, buy another investment property that say is $400,000 to $500,000, and then bonus depreciate out that property in the first year, which means a lot of times you can take off about half, a little less than half of the total value of the property. It's called bonus depreciation. You have to look into it. You do a cost segregation study, bonus depreciate it out, and then you have a loss of say $200,000 on the new property, and the two equal each other. You know, you lost $200,000 on the new property, you gained $200,000 on the one property you sold, and maybe the new property you bought for $500, you put 20% down, that was $100,000. Well, if you got 200 out of the first one and you put 100 down on the new one, well, that freed up the $100,000 that of equity that you could now have access to, and your tax bill is zero. So there is a way, if you're a landlord and you have fully depreciated properties, that you can still get your hands on some of that cash if you need it. And using a cost segregation study with bonus depreciation is the way you get that done. So if you have a property that you want to sell, whether you're a landlord, it's a situation like this, or you have a house that you want to sell, or a condo, or a townhouse, in any of these situations, I can help you get that house sold and put the most money in your pocket. Reach out to me by putting your address in our website at www.denverpropertyflip.com. Again, that's www.denverpropertyflip.com.